Somewhere in Ohio this morning, a retired schoolteacher opened her phone before her coffee finished brewing, checked the silver price, and felt her stomach drop. It was sitting just under $60 an ounce. A few months ago, silver was trading well above $100. She bought some of her position near the highs, and now she's staring at a number that makes her wonder if she made a mistake. But here's what she doesn't know yet, and what most investors watching that same price chart don't know either. While silver's price has been sliding, something very different has been happening inside the actual vaults where the physical metal is stored. And that difference between what the price is doing and what the physical market is doing might be the single most important thing happening in silver right now. Silver has pulled back sharply from its record high earlier this year when it briefly spiked above $120 an ounce during a dramatic run driven largely by expectations that the Federal Reserve would keep cutting interest rates. Since then, the story has flipped. Inflation numbers have come in hotter than expected, oil prices have jumped due to rising tension in the Middle East, and Fed officials have started talking tough again instead of dovish. That combination has pushed silver down, and down hard, in a matter of weeks. Investors who were celebrating triple-digit silver prices in January are now watching it hover in the high 50s, and a lot of them are asking the same question that schoolteacher in Ohio is asking. Did the silver story just end? Before we go further, if you're new here, this channel is called Smart OG John Egg, and the entire purpose of this channel is to help everyday investors understand what's actually happening behind the headlines, not just repeat them. If that sounds useful to you, hitting like and subscribing genuinely helps more people find this kind of grounded, educational market analysis instead of the fear-driven noise that usually dominates precious metals content. It costs you nothing and it helps a lot. Now let's get into what's really going on. Most financial headlines are built around one thing, and that's the price. Price goes up, headline says silver is booming. Price goes down, headline says silver is crashing. It's simple, it's fast, and it fits in a notification banner. But price is only one layer of the story. Underneath the price, there's a completely separate market that most retail investors never look at, and that's the physical delivery market inside COMEX, which stands for the Commodity Exchange, the main venue in New York where silver futures contracts are traded and settled. Here's the part that changes everything. A futures contract is essentially a promise. It's a paper agreement between two parties to exchange silver at an agreed price on a future date. Most of these contracts never actually result in anyone taking physical delivery of metal. They get closed out, rolled over, or settled in cash. But a portion of the market does involve real delivery. Real bars of silver moving out of certified vaults and into the hands of whoever is holding the winning side of that contract. And when you look at that side of the market, the physical side, the picture right now doesn't match the panic implied by the falling price. Registered inventory, which is the portion of silver sitting in COMEX warehouses that's actually available for delivery against contracts, has been a closely watched number all year. Earlier in 2026, that registered inventory sat in the range of 70 to 80 million ounces, a level some analysts flagged as historically tight compared to the amount of paper contracts outstanding. More recent data shows that number has moved higher, suggesting metal has been flowing back into deliverable status, even as the price has fallen. That's an unusual pattern. Normally, when a market cools off and prices drop, you'd expect deliverable supply to sit still or drift lower too, because there's less urgency to hold physical metal. Instead, what we're seeing is a market where paper price is falling while physical positioning is telling a more complicated story. There's another reason the market may be reacting this way, and it has almost nothing to do with silver itself. It has to do with oil. Renewed military tension involving Iran has disrupted energy routes and pushed crude oil prices sharply higher over the past couple of weeks. Higher oil prices feed directly into inflation expectations, because energy costs ripple through nearly everything, from shipping to manufacturing to how much it costs to heat a home. When inflation expectations rise, markets start pricing in a higher chance that the Federal Reserve will raise interest rates instead of cutting them, and that's exactly what's happened. Odds of a rate hike later this year have climbed significantly in a short period of time. This matters enormously for silver, and here's the mechanism most people never think through. Silver, like gold, doesn't pay you interest or dividends just for holding it. When interest rates rise, or even when the market expects them to rise, holding non-yielding assets like silver becomes relatively less attractive compared to holding cash or bonds that now pay more. That's one of the core reasons silver has come under pressure, even while some of the underlying physical supply signals remain tight. The market isn't necessarily saying silver has no value. It's saying that, for now, the opportunity cost of holding it has gone up. What happens next may surprise you, though, because this is where market psychology becomes just as important as economic data. A lot of the recent selling in silver has come from exchange-traded fund holders, meaning investors who own silver through ETFs rather than physical bars or coins. Silver ETF holdings dropped by a meaningful amount between mid-May and mid-June this year. Historically, this kind of ETF outflow tends to reflect short-term, opportunistic trading behavior, rather than a fundamental change in long-term demand for the metal itself. In plain language, a lot of the recent selling looks like traders taking profits after an enormous run-up, not long-term holders abandoning their position because they've lost faith in silver as an asset. Let's pause here for a second, because I want you to picture something. Imagine you bought a house 2 years ago, and its value doubled. Then imagine the market cooled slightly, and the value came down 10% from that peak. Would you say the house has crashed? Or would you say it's still sitting on a massive gain, just breathing after a sharp climb? Silver is still trading significantly higher than it was a year ago, even after this pullback. The panic headlines tend to leave that context out. Here's the part that changes everything again, and it's something most headlines focus on one story, while the real signal may be somewhere else. The relationship between paper silver and physical silver has become one of the more debated topics among serious precious metals analysts this year. Outstanding futures contracts, when converted into ounces, still represent several times more silver on paper than actually sits in registered, deliverable form inside the warehouses. That gap between paper claims and physical metal isn't new, and it isn't automatically a crisis. Most of those paper contracts were never intended to result in delivery in the first place. But when that gap narrows during periods of high delivery demand, it has historically coincided with sharp, fast price moves, both up and down. This is one of the indicators that could change how you see today's market, because it means silver's price can move violently in short windows, independent of what's happening in the broader economy. The market often rewards those who understand this difference between short-term paper positioning and long-term physical fundamentals. Long-term silver demand isn't just about investors buying coins and bars. Silver is genuinely useful. It's used heavily in electronics, solar panel manufacturing, batteries, and a growing number of applications tied to data centers and artificial intelligence infrastructure. Industrial demand for silver has been climbing, and several analysts tracking the physical market have pointed to a persistent gap between how much silver gets produced each year and how much gets consumed. That gap, often referred to as a supply deficit, has now continued for multiple consecutive years, according to industry researchers who track mining output against total demand. Now, I want to be very clear about something, because this channel isn't in the business of making promises it can't keep. Nobody, no analyst, no chart, no historical pattern can tell you with certainty where silver's price will be in 3 months or 3 years. Anyone guaranteeing a specific price target is asking for your trust without earning it. What we can do is look at historical patterns and reasonable publicly available data, and use that to think more clearly about risk and opportunity, rather than reacting emotionally to a single day's price movement. Let's talk about that emotional reaction for a second, because it's incredibly common and incredibly human. Picture an investor who bought silver near the recent highs, watching the price fall week after week. The natural instinct is fear. The natural instinct is to sell before it falls further, to protect what's left. Historically, though, some of the worst long-term outcomes for precious metals investors have come not from holding through volatility, but from panic selling near local bottoms after already missing the gains near the top. That doesn't mean holding blindly is always the right move either. It means decisions made from fear tend to be worse, on average, than decisions made from a clear framework. There's another indicator that could change how you see today's market, and it's one that gets almost no attention compared to the daily price. It's the pace of change in registered inventory over multiple weeks, not a single day. A one-day inventory swing can be noise. A multi-week trend, where deliverable metal is consistently leaving or entering the system, tends to reflect something real happening in physical demand. When you compare that trend against how many paper contracts are outstanding, you start to get a coverage ratio, a rough measure of what percentage of paper claims could theoretically be satisfied with metal that's actually available right now. Historically, when that ratio has dropped into stressed territory, it has often preceded periods of unusual volatility. Right now, depending on which data source you look at and how recently it was updated, that ratio sits in a range that some analysts consider tight, though not universally described as extreme. This is exactly the kind of nuance that gets lost when a headline just says silver is crashing or silver is about to explode. Let's zoom out for a moment and think about history, because silver has been here before in different forms. In the late 1970s and early 1980s, silver saw an extraordinary speculative run followed by a dramatic collapse, driven partly by attempts to corner the market and partly by inflation fears of that era. In 2008, silver dropped hard during the global financial crisis before eventually recovering as investors rediscovered its role as a safe haven. Each of these episodes looked terrifying in the moment to the people living through them. Each of them also eventually gave way to new market conditions that looked nothing like the panic of the sell-off itself. History doesn't repeat perfectly, and past patterns are not guarantees of future results. But they do suggest that sharp pullbacks after major rallies are not unusual for this particular metal. Silver has always been more volatile than gold, largely because of its dual role as both an industrial commodity and an investment asset, which means it responds to two different sets of forces at the same time. So where does that leave an everyday investor trying to make sense of all this? A few practical habits tend to separate calmer, more consistent investors from ones who get whipsawed by every headline. First, separate the signal from the noise by focusing on multi-week trends in inventory and demand data rather than single-day price swings. Second, remember that ETF flows often reflect short-term trading behavior, not necessarily a shift in long-term fundamentals. Third, pay attention to what the Federal Reserve is actually doing with interest rates, since that has a direct and measurable relationship with how attractive non-yielding assets like silver and gold appear to institutional money. Fourth, and maybe most importantly, avoid making large decisions purely out of fear or euphoria. The investors who tend to do best over long periods of time are usually the ones who built a plan before the volatility hit, not during it. We're coming up on the most important part of this conversation, so let's bring it together. Silver's price has fallen from its record highs earlier this year, driven largely by a shift in expectations around Federal Reserve policy, rising oil prices tied to Middle East tensions, and a stronger case for higher interest rates. At the same time, the physical side of the market, meaning registered COMEX inventory and industrial demand trends, has been sending a more complicated and in some ways more constructive signal than the price chart alone suggests. Neither side of this story is the whole truth by itself. The price reflects short-term sentiment, positioning, and macroeconomic expectations. The physical market reflects longer-term supply and demand realities that move much more slowly. Understanding both, instead of reacting to just one, is what separates informed investors from those who are simply along for the emotional ride. I'm curious what you think. If you're holding silver right now, how are you approaching this pullback? Are you watching the price, the inventory data, or something else entirely? Drop a comment and let me know your current outlook, because this community tends to have some genuinely thoughtful perspectives, and I'd rather hear what real investors are seeing than just talk at a camera. And if you know someone, a friend, a parent, anyone who's been asking questions about gold, silver, or how the Fed's decisions ripple through their savings, consider sending this their way. Financial education spreads best when real people share it with people they trust. Markets like this reward patience far more often than they reward panic. Silver has always been a volatile asset, and it will likely continue to be one. What matters most isn't predicting the next move with certainty, because nobody can do that honestly. What matters is understanding the forces at play well enough to make decisions that fit your own goals, your own timeline, and your own tolerance for risk. Every investment decision you make should ultimately come from your own research and your own financial situation, not from a headline designed to grab your attention for 15 seconds. Thank you for spending this time with Smart OG John Ag. Stay curious, stay patient, and keep learning, because that's ultimately what turns uncertain markets into long-term opportunity.